Did you know there are still some bankers and mortgage brokers out there that structure your loans in a way where you're stuck in the bank and you can't refinance out? I'm your host, Tony Shah. Thanks for joining me on another episode of the Mortgage Chat. Today, I want to break down what some of these sneaky people are doing to your portfolios. So everybody, what am I still seeing? I've been in the game for over 10 years and I'm still seeing mortgage brokers and bankers cross-collateralizing all your loans. And what I mean by that is they're joining all your loans and all your securities together instead of separating them and allocating certain loans to that security only. So every security is separated. And why do a lot of people do this? Well, a few reasons. Because they're lazy, they don't know what to do, and they want you to get stuck in that bank and you can't shop around. This is what we call cross-collateralizing. It's the worst thing to do, and the same can be achieved without cross-collateralizing all your properties. And that's what we call dishonest people. Do we do that at the mortgage agency? No, we don't, because we'll rather spend a little bit more time structuring your loans correctly and making sure we can take it to different banks with different securities when needed. And I'm going to show you in a second why it's so important to not cross-collateralize your loans. As an example, let's just say Bank A right here values your property at $1 million, but Bank B right here values your property at $1.15 million. Guess what? You've got a lot more equity here to use in this bank in comparison to this bank. But if this security wasn't cross-collateralized with this bank originally, and this bank here values this property at 1.15 million, guess what you can do? You can refinance back out. But because you're cross-collateralized with this bank, it's a little bit harder for you to refinance out. Your banker, your broker just made it a lot more harder for you to refinance out. And I'll show you in a second. Now, I'm going to jump into my computer. I'm going to show you exactly what I mean as an example. Please jump on YouTube, have a look at this video. It will explain what I mean. So let's get cracking. Okay, everybody, so thanks for joining me on this YouTube channel right now on this middle part of the podcast, all right? Remember, this is just a basic understanding of how cross-collateralization can really hamper you using equity if you were to try to refinance to another bank. So as an example, let's just look at Bank A for now. Originally, your property is worth $1 million and you had a loan of $600,000, okay? Because you have $200,000 of usable equity here, so it doesn't go above 80%, what the banker normally does, or some brokers, is they'll cross-collateralize these two properties. So therefore, your loan up here remains the same, and your loan that was used for this property was $1 million. So therefore, your total portfolio is $2 million at $1.6 million, and your LVR as a whole is still 80%. Now, what I mean by you don't need to cross-collateralize these properties is if you structure it correctly. So for argument's sake, let's just say that, I put this down here, I change this, and I had a loan of $200,000 because I'm using $200,000 of equity from here. Remember, now my second property here, I'm going to borrow 80%, which is $800,000. So guess what? It's still going to be a total loan of $1.6 million at 80%. But in this case, not cross-collateralize the property because I drew out a $200,000 equity loan against property 1, which we use as a 20% deposit for property 2. And hence, the loan against property number 2 is only $800,000. These are by itself, and this is by itself. So I'm not cross-collateralizing anything, okay? So in a normal case, this is what a lot of your mortgage brokers, and look, some bankers will do as well, okay? I'm not going to say every banker is the same, but I'm going to say a lot of bankers still does this, all right? Like I said to you, the same can be achieved without cross-collateralizing. Let me just show you what I mean, how much damage it causes if you were to cross-collateralize a property. Let me just change this back a little bit. Okay, cool. Let's just say, for example, you wanted to use more equity. But as you can see here, you're already at 80%. So unless you pay lender's mortgage insurance, you're not going to get what you want. So in some instances, you can do valuations with other banks to see what valuation comes back at. Okay, now I'm just using Bank B as an example. All right, so just a plain example. I'm not saying, one bank will give your current bank a bigger valuation than other, but I'm just using this as an example. So let's just assume this stays the same. But in property 2, it's worth $1.15 million, right? So your current bank is only worth $1 million, but another bank values it at $1.15 million. So therefore, usable equity is 120 grand. Now, this is where a lot of investors get stuck because they cross-collateralize. They can't refinance just this property over to this bank to use the equity, okay? Now, they can, but there are a few things they need to do. this is where it causes a little bit of a headache before we can go to our end goal. So what we have to do with some of our clients is we have to restructure the loan before we can refinance this property back out. So what I mean by this is we have to uncross these two properties, all right? So what I mean by that is I've got to move 200,000 of this loan back here. So this becomes 80%. And because this is 80% and because this is 80% here, I'm allowed to refinance the loans out because each loan is against each security. So if I was to move this back here, okay, and change this to 800, all right, and change this to 200. So there you have it, right? So now I've restructured the loan to its correct order. The reason why I've segregated these two loans is because when you do your tax returns and you want to claim interest back on these loans, you will tell your accountant that this loan here was used for this property. Therefore, the interest on these two loans is against this property and this is against this, okay? And you're probably asking me, Tony, all right, so why don't I just refinance this property? Because that's got 600 grand and just leave this as is at 1 mil and 1 mil. Well, you can't remember because if you're going to move this property only to use the equity, well, guess what? Your LVR on this loan will be 100%. No bank's going to lend you 100% against one security. Okay, so therefore, that's why you can't just refinance this loan to this bank and leave the $1 million against this property. Okay, and that's why we have to restructure it correctly to be able to release this property. Okay. So I hope you understand that, right? So in the event that another bank values this property higher than what your current bank does, and it is cost collateralized, this is what you have to do in a way, okay? So therefore now I can refinance this property and this loan of 800 grand over here. Okay, I'm probably confusing you here. So let's just delete this, okay? Let's just delete this. I'll just use that as an example. So let's just delete this, okay? So now what does this mean? I'm refinancing this loan here over to Bank B and leaving this loan up here at 100,000. And now I've got Bank A with one security and Bank B with one security. And because this bank values this property at $1.15 million and the loan on it is only 800,000, that means I had 120,000 of usable equity because I can draw it up to 80%. Right now, I only say 70%, but guess what? If I go here, that at 0.8%, what does it come up to? And guess what? 920. So now I've got 120,000 I can use as a deposit, call it 20% deposit for a $600,000 property. So now I've got enough deposit here to cover the 20% for a $600,000 property, and I can buy another property, assuming you've got enough money to cover the stamp duty as well. Okay, but let's just use this as an example, right? Now, if you were to leave this as is, you'll be in trouble. You can't refinance. And even if you have a borrowing power, guess what? You've got no equity to use here because you're stuck here. So that's why I say to a lot of people, you don't need to cross-collateralize a property, all right? The same can be achieved without cross-collateralizing your property as long as you have different loan splits, right? So in this case, like I said to you, put $200,000 right here. You can keep this at 100,000. And bang, all right, guess what? You're not cross-collateralizing it. You're still buying this property at $1 million and you still know what interest to claim when you take it to Mr. Accountant at the end of the financial year to do your tax returns, okay? So there you have it, guys, all right? So this is just a plain, simple example of why you don't need to cross-collateralize. So everybody, I hope you understand the demonstration why cross-collateralizing is actually a bad thing to do. And the same can be achieved without cross-collateralizing. Now, the good thing is cross-collateralization has been decreasing as time gone by, but I still see it on a regular basis, mainly with bankers. Some brokers, but a lot of brokers out there do the right thing, do a bit more work and not cross-collateralize anything. Majority of the time, what I've seen, the bankers will cross-collateralize your loan. So whenever you use a banker because you don't want to use a mortgage broker for argument's sakes, make sure you refer back to this video and understand how to structure your loan so you at least can relay it back to your banker and say you don't want to cross-collateralize your loan. For example, we had a client where had 4 properties all cross-collateralized, right? So they probably had around $4 million worth of assets, and the loan on that was in around $2 million. So all 4 of those properties were cross-collateralized and secured against a business loan, which was only $500,000. But guess what? You didn't need to cross-collateralize all 4 properties. There was too many security attached to each other to provide as a security for that $500,000 loan. And I've done the calculations based on only 2 investment properties that were able to cover the $500,000 business loan against those 2 properties. So really the other 2 properties that they used as a security was irrelevant and they didn't need to do it. They could have refinanced, these two properties out to another bank to get a better product, right? So sometimes when bankers or mortgage brokers do all that, it's because they want you to get stuck with the same bank and can't refinance out. It's not illegal, but it's not the right thing to do, okay? I'm your host, Tony Shah. I hope you learned a few things today. Please always refer back to all my YouTube videos up here and all Prop Spotters videos up here to understand buying properties, structuring a loan, building a portfolio, all that, okay? So please join me on the next episode of the Mortgage Chat, and thanks for joining me today.